So we'll now start with a very important concept of the FRM Part 1 curriculum that will teach us about how to hedge linear risk, also referred to in the curriculum as one factor hedging. We will explain in detail as to what is this one factor and what is the concept of hedging. But please understand that in financial markets and products, or even in understanding value at risk, we have basically just understood the concepts of risk, or we have measured the risk. This is the first time that we will now start to increase or decrease the risk of our position, or start managing the risk of our position. So remember, the process of risk management has 3 steps: risk identification, risk measurement, and risk management. So identification, the risk may come from various sources, can come from market movements, can come from interest rate movements, can come from credit risk, so on and so forth. Measurement is through standard deviation, duration, beta, value at risk, and related concepts. Managing risk is the process of increasing or decreasing the risk of your position so as to bring it between or within contained or acceptable limits, and to basically take on the risks that we want to. Please note, the objective is never to eliminate the risk, because without risk there will be no excess return. So the idea is to take risks that we think we have a competence in, or risks that we think we can measure and manage better, and to keep the risk within acceptable limits. Now, when we talk about hedging, hedging is the process of reducing the uncertainty of your position. So if I have an asset, or if I have a position that can potentially decline in value, then the process of hedging essentially tries to reduce that loss or reduce that uncertainty. Please note, if we hedge, we will reduce our downside, but we will also invariably reduce our upside. Now we've studied various concepts, and we can pretty much define what linear risk implies. Linear risk means that if the underlying moves by delta y, then the value of my portfolio will move in some proportion to delta y. For example, duration is a linear measure of risk, because if interest rates go up by delta y, the value of my position will go down by duration times delta y. Beta, as we studied in linear regression, is also a measure of linear risk. Beta measures the sensitivity of a stock or a portfolio to the market. So if the market goes up or down by delta y, the stock will go up or down by beta times delta y. If beta is greater than 1, then it means our stock is more risky than the market, because if the market goes up or down by 1%, our stock goes up or down by more than 1%. If beta is less than 1, that means our stock is less risky than the market. If the market goes up or down by 1%, the stock goes up or down by less than 1%. Now there may be other factors also that may need to be accounted for example convexity, or for example changes due to credit risk, etc. However, in this review, we will focus on hedging a linear risk, that is, hedging the risk of duration of the bond, hedging the risk of beta of a stock, so that even if interest rates go up or down, the value of my portfolio should not change. Rather, if the interest rates go up, the value of my long position should not fall to the extent of duration. If the stock market goes down, the value of my position should not fall to the extent of beta times the stock market fall. So that's what we are going to try to reduce. So we are trying to reduce the market risk of our positions essentially. Market risk generally would be more a linear risk or would be more impacted by factors like duration and beta. In static hedging, there is essentially no change of the portfolio over the hedging horizon. So once we construct the hedge remains fixed until the 1 year or 6 months or whatever was our hedging horizon. In dynamic hedging, there is continuous rebalancing of the portfolio needed over the hedging horizon. When we studied option Greeks, the concept little bit of dynamic hedging, because we said that the duration of the portfolio, rather the delta of a option, keeps changing with the stock price. So if the delta keeps changing, the hedged position will also need to be adjusted. So in dynamic hedging, essentially we have to continuously rebalance. In static hedging, we do not change the hedge once it is constructed. The concept will be referred to as unitary hedging if the amount sold is the same as the underlying. So let's assume we are hedging a $100 position. There's a $100 position in some asset, and the hedge position or the hedge is also a short $100 or a $100 position in some other contract, then the concept will be a unitary hedge. For example, a US exporter has been promised a payment of 125 million Japanese yen over 7 months. He decides to hedge on the Chicago Mercantile Exchange with contracts of 12.5 million yen that expire in 9 months. So he will short 10 such contracts so as to hedge his payment of 125 million yen. At each date, future price is determined by interest rate parity. Please remember currency forwards that we studied in forwards and futures, and we remembered that the forward price is equal to spot price into e raised to the power r domestic minus r foreign into t, where S and F all have to be in direct quote, that is domestic per unit of foreign. So he says that the future or the forward price at any point in time is given by this no arbitrage relationship that is also known as interest rate parity. So let's understand what is happening here. He is a US exporter. His costs and his expenses are all probably in US dollars. However, the payment that he is receiving is in yen. He is contracted for the products today itself. So he would probably be required to make the products or make his expenses in US dollars. At the current exchange rate, this 125 million yen is remunerative enough. That is, it is bringing him enough dollars even if he converts them into dollars. But the problem is that he is not receiving the payment right away. If he got it right away, he could have just converted it into dollars and enjoyed his dollars. He is getting the payment 7 months later, whereas his expenses are probably going to be right away. The problem that may happen is that 7 months later, the Japanese yen may depreciate. If the yen depreciates, then it will buy back less dollars and he may not get as much money as he anticipated. To hedge this risk, or to hedge his position, it's an asset to him. This 125 million is an accounts receivable. So it's an asset that is going to come 7 months later. What he is doing today is that he will short this 125 million yen 7 months later at whatever is the current forward rate. Please note, the current forward rate will be dependent on the current spot rate for the most part, and then this e raised to power rd minus rf into t. So to hedge his position, he can lock in the value that he will get from this $125 million today by entering a short contract 7 months forward. The small problem, however, is that exactly 7-month contracts are not available on the exchange. The way things look at the moment, the closest contract that he is getting to his maturity is a 9-month contract. So there may be possibly 2-month contracts, 3-month contracts, or 12-month contracts, and some 9-month contracts. The closest that he can see is a 9-month contract. That is, he's not able to short exactly a 7-month contract, even though the payment is expected 7 months later. So what we will advise him to do is that you short a 9-month contract. If the yen actually depreciates, even the 9-month forward price will go down and your short position will gain. The idea is basically to offset the losses if yen depreciates. If yen depreciates, any short position will gain. Any short position on the yen will gain if yen depreciates or yen loses down or loses value. So rather than shorting a 7-month contract, we will short a 9-month contract because it is the only one available. However, 7 months later, once we get our yen and we've converted it, for the 2 months, do we need the hedge? No. Then we will square it off. We can just long a 2-month contract and square off any derivative position. So let's see how this hedge is executed and what actually transpires. So at the beginning, we had a 9-month contract. The US interest rate was 6%, the yen interest rate was 5%, the spot yen to dollar rate was 125 yen per dollar. Please note, the domestic currency now is yen. If we have to make it in the direct quote of a US, then we'd have to do dollar upon yen, that is 1 upon 125. If we continue to solve in this manner, then when you apply your formulae, please remember the domestic currency here is yen, especially when you apply the forward calculation formula as you have studied. So RD would be the yen rate, RF would be the US rate into T. T is in months, so be sure to convert it into years because rates will always be annualized. The spot rate is given. The forward rate for a 9-month contract can be calculated. Please verify. It would be 125 into e raised to the power the yen rate, that is 0.05, minus the dollar rate, that is 0.06, into 9 by 12. So it will come out to be very close to 125, just a minus 1% into 9 by 12 e raised to the power that will give you a forward price today. So this is a today's price for a 9-month forward contract. That is, today our counterparty is short a 9-month contract. And that is at t equal to 9, he will deliver 125 million yen and he will receive 125 divided by 124.07 million dollars. This is a contract that he has entered today itself. This price is fixed today. Whatever be the exchange rate of yen at t equal to 9 will not matter. A forward contract is a right as well as an obligation. He has guaranteed himself so many dollars. If the yen appreciates, he will get nothing more. Upside is also limited. If the yen depreciates, however, he will get nothing less. Downside is also protected. Now what has happened is that 7 months have passed. So we are today at t equal to 7. Our 125 million yen have come to us. And like we were scared, the yen has depreciated. So the yen rate today has become 150 yen to the dollar. That is, for this 125 million yen, wherein earlier we were anticipating $1 million, today actually we will get only 125 upon 150 million dollars, hence there has been a loss. But we also short a 9-month futures to hedge ourselves. Let's see what happens on that position. Is our loss made up for or not? So at t equal to 7, I no longer need the hedge. So I can square off my position and recognize my profit today itself. So to square off the position, I will simply long a 2-month futures. I'm already short a 9-month future to deliver 125 million yen. At t equal to 7, there will be 2 months remaining to maturity of this contract. I'm short 125 million yen, so 2 months forward I will long 125 million yen, and that will square my position off. However, this longing will happen at today's forward rate, not at the forward rate at any earlier time. And today's forward rate can again be calculated by the same formula. So today's forward rate would be 150 into e raised to the power 2%, that is 0.02, minus 0.06 into 2 by 12. It also comes out to be near about 150. So that's a good thing about forwards and futures. Normally the movement will be in tandem with the spot prices for the most part. So the futures have become 149. So he is selling 125 million yen at the rate of 124.07 that he had already contracted. So this is the amount that he will receive for selling 125 million yen. If he longs 125 million yen, then he will purchase 125 million yen, and now he will have to pay 125 divided by 149 million yen. So he is contracted to sell the yen for so much, and he can buy the yen for a lot fewer dollars because the yen has depreciated. So on the whole, on his option position, when he squares off at t equal to 7, he will have a gain of 125 divided by 124.07. This is the amount he receives. This will get cancelled. Minus 125 upon 149. That is the amount that he loses. So this is the payoff on the forward position. On the spot position, he was earlier anticipating 125 upon 125. However, he actually received 125 upon 150 because when t equal to 7 actually came, the exchange rate had gone down for the yen to 150 yen to the dollar. So this difference is the loss in the spot position. This is what the return would have been had he not entered any forward contract. This is the gain on the forward position. This position was created with the intent to hedge against these losses. So please do the calculation and please verify that in dollar terms, what is our total profit or loss, if any at all. Objective was that this should be 0. That is, the loss in the spot should be fully made up for by the gain in the forward. So please verify that this will come out to be approximately equal to $1,900 or a positive $1,900. So what we saw is that even though we had some loss in the spot, this loss was more than made up for by the gain in the forward position. Please note, The construction of the hedge was to protect against any loss. It was actually not to cause a gain. It was to protect against loss. However, there has been a slight gain in the context of $125 million or $1 million. It's not a very big amount, $2,000, but there has actually been a slight gain. This is referred to as basis risk. This has happened because even though our futures have more or less moved in line with the spot, they haven't moved exactly to the same extent. So the spot, for instance, has gone up by 25 units, or rather the yen has depreciated to the extent of 25 units. The forward has also moved more or less to the same extent, but if we calculate exactly the difference, it comes out to be 24.93. So you see there's a 0.07 units difference in the movement of the spot and the futures. This is what is causing the slight gain. If this would have been 25.07, this would have been a slight loss. This is referred to as the basis risk. The basis is the difference between the spot and the futures. If this distance remains constant, the distance between the spot and the futures, for instance, here is 0.93 and here has become 1 unit. If this distance remains constant, then basis risk has not played out, or the basis has remained constant. In this example, we see the basis was 0.93 earlier and has now become 1, implying that the spot has moved by a different extent and the futures have moved by a slightly different extent, causing a slight profit or a slight loss. This is referred to as basis risk. So please note that the gain in our spot position, or rather the loss in our spot position, will be given by S2 minus S1. This will be combined with the gain or the loss on the forward position. So you can write it as minus F2 minus F1. Because if we are long here, we would be short in the forward. If we were short here, we would be long in the forward. So S2 minus S1 was our gain in the spot. This was the final spot price, 1 upon 150 you can say. 1 upon 125 is the beginning spot price. So S2 minus S1 is the gain in the spot position. F2 minus F1 is the change in the forwards price. Because we were short this, it will be a loss. If this was a gain, this will be a loss. If this was a loss, this will be a gain, because it is the opposite position. We were long 125 million yen because we were going to receive 125 million yen 7 months later, and hence we short 125 million yen in the forward. So what we say is that by entering a forward contract, what we have done is that we have changed our position from S2 minus S1 to a total return of S2 minus S1 minus F2 minus F1. This is our net result. So our net gain or loss is now not dependent on just S2 minus S1 or the movement on spot. It is the combined payoff of the movement on spot and the movement in the forward. Or we can write this as S2 minus F2 minus S1 minus F1. S2 minus F2 is the ending basis, the difference between the spot and the futures. S1 minus F1 is the beginning basis. So the net payoff will now be B2 minus B1, that is the absolute change in spot or forward doesn't matter. The risk is only a basis risk. That do the spot move in line with the futures, or do the futures move in line with the spot? If the basis changes, that is, if this difference doesn't remain constant, then there may be a slight gain or loss. In the previous example, we saw there was a slight gain. So remember, a unitary hedge or a forward hedge in this manner converts our price risk. Earlier the risk was price risk into a much smaller basis risk. If you are shorting to achieve your hedge, then the short hedge position is said to be long the basis. When we short this forward, we hedge our position, but the risk was now the basis risk. Is just terminology. The logic is the same. You have a position that can lose value, so you will take the opposite position in a forward contract to hedge your risk. It's called a unitary hedge. We understood the concept of hedging using forwards, and very importantly, we defined and understood what is referred to as basis risk. Once again, basis risk is the uncertainty whether cash and futures hedge will widen or narrow during the hedging period. There is a trade-off between liquidity and basis risk. So if instead of using a 9-month contract, we used a 7-month contract, probably the basis risk would have been a lot lower, because 7 months later the spot would be equal to the futures, or we would know that beforehand, because t equal to 7 our contract is also expiring, and t equal to 7 the money is also coming. But then t equal to 7-month futures are not available or are not liquid. So liquid available futures were of 9 months. Hence we accepted some basis risk in order to take a position in a liquid available contract. So normally there's a trade-off between liquidity and basis risk. If we fought very hard, probably would have found an over-the-counter party who was willing to enter into a 7-month contract. But then there would not be enough liquidity. If something went wrong, I wanted to exit that contract, I wouldn't be able to. A 9-month futures contract was easily available, highly liquid, no counterparty risk. So generally we see some trade-off between liquidity and basis risk, as we saw in our example. Basis risk is higher with cross-hedging. Cross-hedging is when instead of shorting yen, what did I do? I was long yen, 125 million. To hedge my position, I short the yen. Let's assume short contracts on yen were not available. So I short contracts on the Korean won or on Hong Kong dollar, seeing that the yen and the Hong Kong dollar are very highly correlated in the past. In the cost, when the Hong Kong dollar depreciates against the US dollar, Japanese yen also depreciates against the US dollar. So my idea was to benefit when yen goes down. Instead of shorting yen, I've shorted a Hong Kong dollar because contracts on yen were not available. This is referred to as cross hedging. Definitely basis risk will tend to be higher, because as yen moves, historically HKD has also moved, but we know that it may or may not exactly move by the same extent. What feature of cash and futures prices tends to make hedging possible? That is, the futures price and the spot price, how are they related? They always move together in the same direction and by the same amount? Not always. They move in opposite directions by same amount. they tend to move together generally in the same direction and by the same amount. That's true, except for a small basis risk. They move in the same direction by different amounts is incorrect. Under which scenario is basis risk likely to exist? A hedge which was initially matched to the maturity of the underlying is lifted before expiration. Yes. So t equal to 7 is when our money was coming, and t equal to 7 is when we had shorted the yen. That was a perfect hedge because there was no basis risk. As the money comes, I give it to somebody else, my payoff is fixed. But if I lift it before expiration, let's say t equal to 6, I square off. In such a case, it's possible that the spot and the futures may not have exactly moved by the same amount. Some basis risk is possible. The correlation of the underlying and the hedge vehicle is less than 1 and their volatilities are unequal. So if the correlation is less than 1, that means that they always do not tend to move together by the same extent, and the volatilities are also different. So yes, some basis risk may exist. The underlying instrument and the hedge vehicle are dissimilar. This is what we studied in the concept of cross hedging. So that also causes basis risk. So all of the above are correct. After unitary hedging, we'll now begin with a very important concept of beta based hedging. So now the hedge amount needn't necessarily be the same as the underlying and will depend on various factors. Before we study beta hedging, let's understand and revise what beta is. So when we studied linear regression, please understand that the dependent variable was equal to alpha plus beta times the independent variable. Beta measured the sensitivity of the dependent variable with the independent variable. There was an error term. That is, if x went up or down by 1 unit, dollar, percentage, whatever the unit of x may be, if x went up or down by 1 unit, y went up or down by beta units in whatever the units of y are. So beta measures the sensitivity of the dependent variable with the independent variable. Generally speaking, in the context of equities, the independent variable is the market and the dependent variable is the portfolio or the stock. So we say that the return on the portfolio is beta times the return on the stock, or if the market goes up or down by delta y, the stock will go up or down by beta times delta y. Generally, or this is the most common application of beta in equity markets or in hedging. So beta measures the sensitivity of my portfolio with the market, or the sensitivity of the stock with the market. However, this needn't be the only application. A lot of times x is some futures and y, or rather beta, is the sensitivity of the underlying to the futures price. So y may still be Rp alpha plus beta times the return on the futures plus an error term. So beta in this case will be the sensitivity of the movement of the stock price with the futures price. As the futures moves, this beta generally is expected to be 1. That is what we just studied. That is, the stock moves in line with the futures. But at times there may be some sensitivity of 0.9, maybe 1.1 or 1.05, that is, it's not an exact one-to-one movement. Similarly, beta can be calculated between any two variables, the dependent and the independent variable. Beta measures the sensitivity of the dependent variable with the independent variable. Please remember, beta is calculated as the covariance of the dependent variable with the independent variable upon the variance of the dependent variable. The covariance of the portfolio with the market generally divided by the variance of the market. Please recall the formula of correlation between y and x. Correlation was defined as the covariance of y and x divided by the product of the standard deviations. So, if we rearrange this equation, we can write that covariance of y and x can be given as the correlation of y and x into sigma y into sigma x, or beta can be written as correlation of y and x, or correlation of RP with the market into sigma y into sigma x, and variance of x or variance of the market can be written as sigma x squared, or a beta can also be written as the correlation into sigma y divided by sigma x. So the correlation of the portfolio with the market or the stock with the market into standard deviation of the portfolio upon standard deviation of the market is the same thing. Depending on what information is given, you will decide which formula to apply. So it is the covariance upon the variance, covariance of the stock and the market upon variance of the market, or correlation times the standard deviation of the portfolio divided by the standard deviation of the market. From a practical perspective or a usage perspective, beta is the sensitivity of the stock to the market. So if the market moves by delta y, the stock will move by beta times delta y. So that was just an introduction to beta. Please tell me, if one portfolio has a beta equal to 2 and another portfolio has a beta equal to 0.8, which of the two portfolios is more risky? Portfolio with a beta of 2 is more risky, generally speaking, because if the market today goes up or down by 10%, this portfolio will go up or down by 20%, whereas the second portfolio will go up or down only to the extent of 8%. So this portfolio is more risky. Higher the beta, more is the risk in the portfolio. Let's assume that I expect the market to go up by 10%. My view is that in the next 1 month, the market will go up by 10%. Would I want the beta of my portfolio to be high or low? If I'm expecting the market to go up, I would want to keep a high beta so that my beta or my portfolio goes up multiple times the market. My portfolio goes up by 30% if the market goes up by 10%. That's what beta tells me. If I'm expecting the market to fall by 10%, would I want the beta to be high or low again? In this case, I would want the beta to be low, because if the market falls, if my beta is for instance only 0.2, then my portfolio will fall only by 2% even though market falls by 10%. So many a times, depending on our view, we may want to alter the beta of our portfolio. In the process of beta hedging, we will essentially learn how to change the beta of our portfolio from a target beta of beta t, rather from a current beta of beta p to a target beta of beta t. For instance, the current beta may be 3 and I expect the market to fall. So I want to reduce the beta to 0.2 or maybe reduce it to 0 so that the beta or so that the portfolio doesn't change at all even if market changes. That's what a beta of 0 means, that even though market may go up or down, my portfolio will not change. Or at times I may want to increase the risk. Beta hedging generally means reducing the risk, but at times I may have a low beta and I want to take the beta up because I feel the market is going to go up and I don't want to miss out. So that's what we are going to study in the coming concepts, that is how to change the beta of the portfolio. Now what is provided is that beta p is the beta of the portfolio, beta t is the target beta, Vf is equal to Pf into M, that is the value of one futures contract, beta F is the beta of the futures contract, Pf is the price of one futures, but please note one futures will normally not be allowed to be purchased. You have to buy in lots and the minimum lot size is M. M is also referred to as the multiplier. So this is the total value of one futures contract that you can enter, that is Pf into M. If Pf and M is given, you multiply them, otherwise we will just use Vf as the value of one contract. Vp is the current size of portfolio. Question asks, convert beta p to beta t with the help of the futures contract. That is, change the beta of your portfolio from a current value to a target value. Now beta is defined as the change in the value of a portfolio for a 1 unit change in the market or for a delta Y change in the market. So if the market, let's assume, goes up by delta Y, at the moment what will be the change in the value of the portfolio? It will be Vp into beta p into delta Y. If the market goes up by 2%, our portfolio will go up by 2 into beta percent. Multiply this with the value of the portfolio will be the absolute dollar change in my portfolio. What I want is that the change should not be so much. I actually want that the change should be equal to Vp into beta t into delta Y. Somehow the actual change in my position, I don't want it to be equal to beta p, I want it to be equal to beta t times delta Y. That is, my portfolio should actually change according to the target duration. To achieve this, what I have is the help of a futures contract which has a value of Vf and a beta of beta f. Let's assume that we long or short n contracts. So n is the number of contracts or number of futures contracts purchased. So let's assume N we assume to be long. So we long N contracts. If we need to short, automatically N will come out to be negative. So it doesn't matter whether you start with a long or short assumption. So if we also purchase N contracts over and above this portfolio of ours, then these N futures contracts will change to the extent of N into the value of one contract into the beta of the futures contract into delta Y. And what we need to ensure is that this total change in the position is equal to Vp into beta T into delta Y. So with the help of this futures position, what we are doing is that we are changing the value, or we are modifying the change in the value of the current position so as to equal it to the target beta. Delta Y will get cancelled. Let's keep N on the left hand side and we'll take this on the right hand side. So N into Vf into beta F will be equal to Vp into beta T minus Vp into beta P. Or you can calculate N, that is the number of contracts needed, as beta target minus the current beta of the portfolio into the value of the portfolio divided by the value of one futures contract divided by the beta of the futures contract. So it will be beta T minus beta P upon beta F into Vp by Vf. Vp is the value of the portfolio known. Vf is the value of one futures contract also known. Beta target is a target beta. Beta P is the current beta of our portfolio. And beta F is the beta of the futures contract. Now many of times you will be asked to calculate the zero volatility hedge or a perfect hedge. Create a perfect hedge or a zero volatility hedge. A zero volatility hedge implies that the value of our portfolio shouldn't change at all. Even if market changes, the value of our portfolio should see no volatility, or the value of your portfolio should not change. The value of the portfolio should not change at all. That means what is the target beta that we want? 0. Hence, a zero volatility hedge or a perfect hedge simply means that the target beta is equal to 0. So if beta T is equal to 0, can we compute N? It will come out to be minus beta P upon beta F into the value of the portfolio upon the value of the futures contract or the value of one futures contract. Please note, N comes out to be negative in this case. That means we need to short N contracts. Please note, N can't be a decimal. So even though your answers in many cases will come out to be a decimal, you can either short 11 or 12 contracts. You can't short 11 and a half contract. So the answer generally will be the closest round number to whatever answer you calculate from this formula. So remember the first formula, that is to change the beta of the portfolio to a target beta. This is the number of contracts that you need to purchase, that you need to long. Perfect hedge means target beta is equal to 0. Please note, many a times, instead of giving the betas with the market, this beta is the beta of the portfolio with the market. This beta F is the beta of the futures with the market. Sometimes the beta of the portfolio with respect to the futures itself is given. That is, if the futures changes by so much, then the portfolio changes by so much. If this beta is not with respect to the market, it is with respect to the futures position itself, then beta of the futures will be inputted as 1. Just like beta of the market is equal to 1. If the market goes up by 1%, the market goes up by 1%. If it goes down by 2%, it goes down by 2%. So beta of an instrument with itself is always equal to 1. So these betas are both with respect to the market. If the beta is given with respect to the futures, then you don't need a beta of futures, because beta of futures will be 1. It's not a tough concept. Once you see the question, you will automatically be able to figure it out. So let's do a few questions and understand this concept better. Never mind this earlier proof. Just remember, the minimum variance hedge ratio is defined as the amount of futures that need to be shorted for 1 unit of the spot position. To construct a minimum variance hedge or a zero volatility hedge. What is the minimum variance that can be? Variance is a square, it can never be negative. Minimum variance can be 0. So minimum variance hedge is the same as a zero volatility hedge. The minimum variance hedge ratio is the amount of futures that need to be shorted for 1 unit of the spot position. So we derived that the number of futures contracts needed is equal to beta of the portfolio into the value of the portfolio upon beta of the futures into the value of 1 futures contract. If you take N into VF on the left hand side and we take value of the portfolio down below, this would come out to be beta P upon beta F, or we can simply write this as beta of the portfolio with respect to the futures. So beta, that is correlation into sigma S upon sigma F, that is the beta of the portfolio with respect to the futures, is also referred to as the minimum variance hedge ratio. That is, this is the total amount of futures contracts, N into the value of 1 contract, and this is the total value of the position. So for every dollar of the spot, you need so much of the futures, or for every dollar of the spot, you need beta dollars of the futures to be shorted. Again, it follows from the same concept that we have derived. You don't need to separately remember this. If you remember the first formula, you will be able to derive this on the exam yourself. Just remember, the minimum variance hedge ratio is equal to the beta, or it is the beta of the portfolio with the futures contract. Minimum variance means the target beta should be equal to 0, or it is a zero volatility hedge. It is the amount of futures that need to be shorted for 1 unit of the spot. Once again, the optimal hedge is given by the negative of the beta coefficient of a regression of changes in the cash value on changes in the payoff on the hedging instrument. This hedging instrument is generally the futures contract, or the minimum variance hedge ratio is the beta of the stock with the hedging instrument. If two securities have the same volatility and a correlation equal to minus 0.5, their minimum variance hedge ratio is. Please remember, minimum variance hedge ratio is given as minus of beta of the stock with the hedging instrument, or beta of the stock with the futures. Beta is defined as minus of, or rather beta is defined as correlation into sigma of the portfolio upon sigma of the futures. Correlation is given to be minus 0.5. Sigma of the portfolio is given to be the same, so this ratio will be equal to 1, so it will be equal to 0.5 or 1 upon 2. So the minimum variance hedge ratio can set to be 1:2 or 2:1. So 2 units of one stock need to be shorted for 1 unit of the other stock. Please note, to hedge we don't necessarily have to use a futures always. If we are long stock A, we can simply short stock B also, given B is highly correlated with A, or B is correlated to some extent, so that this shorting will create a hedge. A company expects to buy 1 million barrels of West Texas Intermediate crude oil in 1 year. The annualized volatility of the price of a barrel of WTI is calculated at 12%. The company chooses to hedge by buying a futures contract on Brent crude. So he needs to purchase the West Texas Intermediate crude 1 year later. His risk is that 1 year later the price may go up, or the price may become out of range for him, or if it goes up, he'll have to incur extra money and he will have a loss. To hedge this risk, he could have just longed the future today and fixed his purchase price. However, for whatever reason, the futures on WTI are not available, so he hedges by buying a futures on Brent crude. The annualized volatility of the Brent futures is 17% and the correlation coefficient is 0.68. Calculate the variance minimizing hedge ratio. So the variance minimizing hedge ratio is essentially a zero volatility hedge. That is, the beta of the position overall, target beta should now become 0. Let's assume the current beta of the spot position with the hedging instrument or with the forward instrument is given, that is beta SF. Then if the forward position or the market moves by delta Y, now the market is the forward position, then the spot will change by beta into delta Y. Let's say we have a position of $1 million in the spot. We are long $1 million, and if this goes up by beta into delta Y, our position will lose beta into delta Y. To whatever extent the price of WTI goes up will be my loss, because I have to buy 1 million barrels. If it goes up by $1, $1 million will be the loss. If it goes up by $10, $10 million will be the loss. So to whatever extent the price of WTI goes up by will be my loss. And how much does the price of WTI go up by? The price of WTI goes up by beta times the change in the price of Brent. If the Brent changes by delta Y, WTI will change by beta times delta Y. That is the definition of beta, the change in the spot for a 1 unit change in the forward. So if Brent goes up by delta Y and I'm long N contracts, then my gain will be equal to N into delta Y, and this total change I want should be equal to 0. Hence, we can calculate that Vp into beta is equal to N, or N upon Vp would be equal to beta. N is the number of forward contracts needed per unit of spot, or this is the definition of the variance minimizing hedge ratio. That is the number of units of the forwards or the futures needed per unit of the spot in order to make the target beta 0 or construct a 0 volatility hedge. So this comes out to be beta. Beta can be calculated as rho into sigma p divided by sigma f. Rho is given to be 0.68 into sigma p, that is the sigma of the portfolio of WTI, that is 0.12, divided by sigma of the forward or sigma of the hedging instrument, that is 0.17. Please note, if the question asks variance minimizing hedge ratio, you don't need to do all this proof. This proof is just for your better understanding. You need to calculate the beta of the spot with respect to the hedging instrument. That is, if the hedging instrument moves by delta Y, if Brent moves by delta Y, the WTI or our spot position will move by beta times delta Y. And in such a scenario, beta is also the hedging instrument as we have proved, or the minimum variance hedge ratio as we have proved, that is the amount of forward needed per unit of the spot. So we need to long, in this case, 0.42 barrels of Brent. This comes out to be 0.48, or this comes out to be 0.48, or we need to long 0.48 barrels of Brent futures for every 1 barrel of West Texas Intermediate crude. In this case, we need to long 0.48 million barrels of Brent to hedge our position. Now, exactly similar is the concept of duration based hedging. Duration, please recall, is defined as the modified duration, or the percentage change in the value of a bond or a bond portfolio for a 1% change in interest rates. That is the definition of duration. Now, if the duration of a bond is 10 years or is 10, that means if interest rates fall by 1%, the value of this bond will go up by 10% approximately, because duration is an approximation. If interest rates go up by 1%, the value of the bond will fall by 10%. That is what is the meaning of duration. It is the percentage change in the value of a bond for a 1% change in the interest rates. Now, if I am expecting interest rates to go down, would I want to keep a high duration or a low duration? I would want to keep a high duration, because as interest rates go down, the price of bond goes up. If my duration is high, it will go up by a higher percentage. If the duration is low, it will go up by a lower percentage. If I'm expecting interest rates to go up, then I would like to run a low duration, because as interest rates go up, value of bond falls to the extent of the duration. If interest is low or duration is low, the fall will be lower. If duration is high, the fall will be higher. So just like we studied how to change the beta of the portfolio from beta P to beta target, we can be asked to change the duration of the portfolio from dp to dt, where dp is the current duration, dt is the target duration, df is the duration of the futures contract, and similarly vp is the value of the portfolio, vf is the value of one futures contract. So let's assume that interest rates go up to the extent of delta y. If interest rates go up by delta y percent, then what will be the current change in the value of the portfolio? It will be minus duration of the portfolio into the value of the portfolio into delta y. This will be the loss. Let's assume that I am long n futures contracts. Then the futures will also fall to the extent of n into the value of the futures contract into duration of the futures contract into delta y. This is the fall in the value of our portfolio. This will be the fall in the value of the futures position. This should equal to value of minus Vp into dt into delta y. What we want is our position to behave like it has a duration of dt. A duration of dt means the portfolio should fall to the extent of Vp into dt into delta y if interest rates go up by delta y. So again, we can solve this equation and try to compute the value of n. Delta y will get cancelled. We'll take n on the right hand side. So n into Vf into df will become equal to Vp into dt minus dp into Vp, or dt minus dp into Vp, or we can say that n will come out to be dt minus dp upon df into Vp upon Vf. So to change the duration of the portfolio from a current value of dp to a target value of dt, we need to long n contracts, that is dt minus dp upon df into Vp upon Vf. Vp is the value of the portfolio, Vf is the value of one futures contract, that is the price into the multiplier. So this is how we can change the duration of our fixed income portfolio. Once again, a minimum variance hedge would imply what? Would simply mean that the target duration is equal to 0. That is, even if interest rates change, the value of my portfolio should not change. So minimum variance hedge means the target duration should be 0, or n would be equal to minus dp into Vp upon df into Vf. This is nothing but the dollar duration of the portfolio divided by the dollar duration of one futures contract. df is the modified duration, dp is the modified duration, dp into the price would be the dollar duration. So if you remember the general formula, then everything else can be derived from that same formula. It was the same formula for beta. It was beta target minus beta portfolio upon beta F into VP upon VF. Just remember, in many cases, beta F may be equal to 1 if the beta is calculated on the hedging instrument rather than on the market. The optimal duration hedge is given by the ratio of the dollar duration of the portfolio to that of the hedging instrument. Albert Henry is the fixed income manager of a large Canadian pension fund. The present value of the pension fund's portfolio of assets is CAD 4 billion, while the expected present value of the fund's liabilities is CAD 5 billion. The respective modified durations are 8.254 and 6.825 years of the assets and the liabilities. The fund currently has an actuarial deficit. That is, the assets are lower than the liabilities. 4 is less than 5. And Albert must avoid widening this gap. There are currently two scenarios for the yield curve. First scenario is an upward shift of 25 basis points. That is, all interest rates can go up by 25 basis points. Second scenario is a downward shift of 25 basis points. That is, all rates can go down by 25 basis points. The most liquid interest rate futures contract has a present value of 68336 and a duration of 2.1468 years. Analyzing both scenarios separately, what should Albert Henry do to avoid widening the pension fund gap? Choose the best option. So the gap is defined as assets minus liabilities. This gap should not widen. Currently, assets are 4 and liabilities are 5, so there's a $1 million gap. Let's assume first that interest rates go up by 25 basis points. If they do, the assets will fall by 4 into 8.254. So for a 1% change, it would have changed by 8%. For a 0.25% change, it will change by 0.25 into 8.254. So the first scenario, of interest rates go up by 25, this will be the change in the value of the assets. But fortunately for us, the liabilities will also fall. The liabilities will fall by 5 into 0.25 upon 100 into 6.825. You can multiply it with 10 to the power 9 to calculate the answer in dollar terms rather than billions of dollars. This will be in billion of dollars. If you multiply it with 10 to the power 9, we'll get the answer in dollars. Let's first calculate the change in assets. So that will be 4 into 0.25 into 8.254 divided by 100. That will be 0.08254 billion dollars, or you can multiply it with 10 to the power 9 and that will give us the answer in million dollars. So let's store this in the memory register 1. We'll keep it in billions for the time being. Similarly, let's calculate the change in liabilities. That will come out to be 5 into 0.25 into 6.825 divided by 100. So this change comes out to be 0.08531. We'll store it in the memory register 2. So the assets fall by $0.08254 billion and liabilities fall by $0.08531 billion. So what we see is that if interest rates go up, the situation is beneficial to us as liabilities are falling more than the assets, and hence our gap will be reduced. Assets also fall, but fortunately liabilities fall more. If interest rates had gone down by 25 basis points, the situation would have been exactly the opposite. The numbers would have remained the same. This would have been plus and this would have been plus. So in a decrease of interest rates, assets would have gone up by only $0.0254 billion, whereas liabilities would have gone up by $0.08531 billion. That is, the gap would have further widened as liabilities would have gone up more than what the assets would have gone up. So if interest rates are going up by 25 basis points, so the first scenario is an upward shift, we need to do nothing because interest rates going up is helping us. If interest rates went down by 25 basis points, then there would be a widening of the gap to the extent of 0.0853 minus 0.08254, or this would be our loss in absolute terms. This is the loss that we want to hedge or that we want to make good. Let's assume that we long N contracts. If we long N contracts, then when interest rates go down, N contracts will go up by N into 0.25 divided by 100 into the duration of one contract into the value of one contract. So into 2.1468 into the value of one contract, that is 68336. Please note this is in billion dollars, so you can compute N as this difference that is 0.0027 stored in the memory register 3. We'll first compute 10 to the power 9, that is $1 billion, and multiply it with recall 3. So about $2.77 million is what our loss comes out to be. Store this in the memory register 4. So N comes out to be approximately equal to $2.77 million divided by 2.1468 into 68336 into 0.25 multiplied by 100. This is what our loss was, and we want the N futures contracts to make good this loss. Loss is happening when interest rates go down. So if we long the contracts, they will gain. If we short contracts, then when interest rates go down, they will lose. So if we are long N contracts, the answer comes out to be positive. It comes out to be 2.77 into 100 upon this value. Let's calculate. So $2.77 million already there, divided by 2.1468 divided by 68336 divided by 0.25 multiplied by 100. So it'll give us the answer as 7559.45. So we need to long 7559 contracts in the second scenario when interest rates go down. So in the first scenario, do nothing. In the second scenario, long these contracts so that whatever loss you have, as liabilities go up more, you have a loss. This loss is made up for by the gain in the forward position. What assumptions does a duration based hedging scheme make about the way in which interest rates move? All interest rates change by the same amount. A small parallel shift occurs in the yield curve. Any parallel shift occurs in the term structure. Interest rate movements are highly correlated. Please note, a duration based approximation will work if and only if there is a small parallel shift in the yield curve. Large changes, any change will not matter because large changes will cause convexity to come into play. Only for small changes convexity can be ignored. And the changes have to be parallel. That is, all rates have to go up or down by the same amount. It's not the 1 year rate that can go up and the 3 year rate that can go up and the 2 year rate remaining constant. That's not allowed. So all rates have to change. That is a parallel shift and it has to be small. That is why we can ignore convexity. Let's do one last question to revise the concept of beta hedging and apply it. A fund manager has a USD 100 million portfolio with a beta of 0.75. The manager has bullish expectations for the next couple of months and plans to use futures contracts on the S&P 500 to increase the portfolio's beta to 1.8. Given the following information, which strategy should the fund manager follow? The current level is 1250 and each S&P futures contract delivers 250 times the index. The risk-free rate is 6% per annum. We are given the current beta of the portfolio. We are given the target beta. Once again, I will quickly derive the formula. At the moment, the change in the value of the portfolio would be Vp into beta P into delta Y if the market goes up by delta Y. Let's say we take a position in N contracts. The N futures contracts will go up by N into Vf into beta F into delta Y. What we want is that this change should be equal to Vp into beta target into delta Y. If we rearrange this equation, delta Y will get cancelled and we proved that N comes out to be beta T minus beta P upon beta F. Same in the duration. Duration target minus duration portfolio upon duration of the futures into value of the portfolio upon value of one futures contract. All the inputs are given, so we now need only substitute. Beta of the target is given to be 1.8. Beta of the portfolio is given to be 0.75. Beta of the futures is not given, but we are given that these are S&P futures contracts. So beta of the market is close to 1. Hence we can assume that the beta of the futures is 1 since the futures are on the S&P 500, that is a broad market index. Value of the portfolio is given to be 100 million, that is 100 into 10 to the power 6 divided by value of the futures. Value of one futures is 1250 into 250 times the index. That's the minimum I can purchase. So divided by 1250 into 250. Please note this risk-free rate of 6% is redundant. We didn't need this in the calculation. So it will be 1.8 minus 0.75 into 100 into 10 to the power 6. We'll store this in 1. We'll calculate 10 raised to power 6. 10 raised to the power 6 multiplied with recall 1, store it in 1 again, and 1250 multiplied by 250 can also similarly be calculated. Store this in the memory register 2, recall 1 divided by recall 2 will give us the answer as 336 contracts. Please verify this comes out to be 336. So enter into a long position of 336 S&P futures contracts. That's what N also came. If you want to change the beta from 0.75 to 1.8. So that was an important concept of linear hedging. Practice a lot of questions, very likely to be tested. Questions of these types, they're pretty straightforward once you understand the concept. Practicing 10 to 12 questions on your own will give you that confidence. So thanks a lot, and we'll study more about market risk measurement and management in the coming sessions.